We have Domino's Pizza, Starbucks, Home Depot, and JP Morgan Chase. And in this episode, we're going to be going over each of these great dividend-paying companies and seeing if any of them are currently a buy. So we have a lot to get into today. Let's go ahead and jump right in. First of all, this is my portfolio. It's real money. It's called the passive income account. And currently it stands around $350,000, with $54,000 of that being gains. Now, I started this channel 3 years ago as an experiment to track a real portfolio and real investing. I've given updates on this portfolio showing transparently my gains or losses every single week. And I show the total portfolio value on the thumbnail, so you can kind of see the progress of me building this portfolio along the way. And when I say that I show my portfolio transparently, good or bad, whether or not I'm making gains or losses, I really do that. Here's a video on March 20th, 2020. This was the absolute bottom of the pandemic. In fact, this was the day of the bottom, and I still uploaded a video showing how bad my portfolio looked. Overall, I was deep in the red, and I gave up all the gains that I had made for the past 2 years. But I wanted people to see that this type of thing can happen, that black swan events can happen, and they wipe out a lot of the gains. Look at my portfolio at this time. Every single sector in my portfolio was in the red except for utilities and tech. The reason tech wasn't in the red is because I held Apple and Microsoft for a long time. That kept me in the green. But I highlight this to show a big part of what this channel stands for and what we show here. We show complete transparency. Now, of course, in that video, I explained that even though I was deep in the red, I was going to keep investing, keep buying, and ignore the pessimists. Because over time, the market typically recovers, the gains are returned, and you make money if you buy substantially during market downturns. Now, that's what I did, and currently the portfolio has recovered. It's in the green. We have big up days like today where we're up 1.75%. That's $6,000, and this all feels really good. Even with this little downturn, it still feels good to be in the green. But keep in mind what it takes to get to this point of being well into the green. We all have to look stupid at some point or another. All of us make bad investment decisions. When I was investing in March of 2020, my biggest allocation, one of the biggest things I was invested in was real estate. And real estate, of course, did terrible in 2020. It was down 65%, and it was very discouraging at the time. But when I held on to most of these holdings and even reinvested, most of them recovered. Now consider some of the events we've been investing through for the past couple of years. We've been investing through a pandemic. For all intents and purposes, it seems like we're getting to the end of the pandemic. Yes, the virus will still remain, but I think most of us are moving on at this point. President Biden said in his State of the Union address last night that COVID-19 should no longer dictate how we live. This was taken as a signal that it's time to move on. And even states like Hawaii are now removing all of their mandates. We've been investing through a presidential election. That's always a very volatile time. Even in the stock market, many people predicted incorrectly that the presidential election would cause a stock collapse. We've been investing through high inflation. The inflation numbers are the highest they've been in 40 years, and we still have no immediate indication that the inflation is going to go down. We're investing with the knowledge that the Fed is going to raise interest rates. This is something that almost always causes stocks to go down, as interest rates going up create more opportunity to invest in things outside of stocks. So it makes stocks by comparison less valuable. And now with the prior threat being interest rates going up, the new threat is war. Russia, of course, is attacking Ukraine, and they've made, quote, a strategic shift where they're now trying to demoralize Ukraine by attacking civilian areas. And now they're doing more of a strategy of just bombarding Ukraine with bombs rather than trying to go in and have a clean victory. In response, Russia is getting sanctioned by most of the world. Russia races to protect financial system from the barrage of sanctions. They've halted trading in Moscow, and they're trying to protect their economy. President Biden says that we're not sending troops on the ground, we're not sending Americans over, but we will supply Ukraine with money and arms. Here's a photo of one of the shipments that the US sent to Ukraine. And governments aren't the only ones getting involved in this effort. Visa and MasterCard blocked Russian banks from their network after the sanctions. Apple has halted all product sales in Russia, barring them from buying any of their devices, and they've also closed off key things with their services, like events on their maps, in order to try to protect Ukraine from Russia using that information. And Google has basically done the same thing. And there's a lot of other companies doing the same. Movies, concerts, sports give Russia the cold shoulder. Netflix, Disney are among the entertainment providers to show opposition to invasion of Ukraine by pulling back Russian market. And even the teen who was tracking Elon Musk's jet is now chasing Russian tycoons, of which Biden said that he's launching a new klepto capture task force to go after Russian oligarchs. Now, I highlight all of this to say that the past couple of years have been crazy. They've been nothing short of insane. And despite all of this happening in a concentrated amount of time, the S&P 500 is up 83% over the past 5 years. In fact, this big sell-off that we're experiencing right now is down 8% from its all-time high, and it brings us all the way back to September of last year. Only a few months. So knowing that we're going through a pandemic, we've gone through presidential elections, we're going through high inflation, interest rates going up, and a war in Eastern Europe, that's not bringing the stock market down. What can bring down this stock market? That's what I'm unsure of. Maybe a recession, maybe another black swan event. I think those are the only things that can really bring this market down. So despite all this crazy stuff happening in the news right now, I still remain fully invested in my portfolio. And that's because I don't know what can really bring down this market. It seems to be holding up pretty well even despite all the crazy news going on. What I plan on doing is continuing to find deals in high quality dividend paying companies. That's how I've constructed this portfolio. That's how I'll continue to invest. To look at potential deals, I'll be using the Dip Finder. This is a tool that I developed. It's part of the Patreon membership here. It shows you which companies are on a dip and which ones have a price surge. So the ones that are on a dip are below the x-axis here. They have a negative percentage. T. Rowe Price is on the biggest dip. I've already bought a little bit more of that company. We also have Starbucks. It's on a pretty substantial dip. It's down 19% below its 200-day moving average. JP Morgan has also decided to sell off a bit. It's down 14% below its 200-day moving average. This is what that sell-off in JP Morgan looks like. Over the past year, it was pretty flat. There wasn't much momentum either way. And then in just the past couple of weeks, it's gone down 13%. It is in a pretty decent dip now. Then we have Domino's Pizza. This is a company that I currently don't own. This is a Bill Ackman holding. Bill Ackman sold out of Starbucks during a high in Starbucks to buy Domino's Pizza right when it hit $3.30, March 5th of 2021. So he got a killer deal on this company. It instantly went up quite a bit, 60% in just the course of like 6 months. And now it's traded back down and it's up 30% overall for him. So Domino's Pizza had pretty good momentum moving upwards. It hit a few peaks and now it's moving back down. It's down 23% from its recent high, but it's still up 25% over the trailing year. And then the last one we're going to be looking at is Home Depot, which is 8% below its 200-day moving average. Now let's go ahead and start off with Starbucks. Every one of these companies we're going to be talking about are companies that I consider to be very high quality. By that, I mean they have wide moats, they have good unit economics, they have secular trends that are positive, they're moving in the right direction, they have large total addressable markets, and they have decent leadership. Starbucks is one of these companies that checks all the boxes of a high quality company. Now, I've done in-depth research on this company in the past, so you can reference older videos if you want more in-depth research, but I just want to talk mostly about the valuation. I purchased $25,000 of Starbucks at roughly $96 a share, and I'm currently down about $1,000 so far. So just a little bit, 2 or 3%. It's been bouncing around quite a bit. Like the Dip Finder showed, Starbucks is on a downtrend. The company's down 20% from its all-time highs, and now it's starting to trade more flat. I was hoping to buy more of this company if it went down below the 90s. If it got to $87 a share, $85 a share, then I'd use that as an opportunity to dump the $5,000 I have in cash into that company. But it just hasn't gotten there. The lowest it's got is barely into $89 a share. So it's bouncing around at this point. I'm going to hold off buying more of it right now. But again, if this company dips down to $85 a share, I'll be buying more of it. And in the meantime, I'll be happy sitting around and collecting dividends from this company because they pay a pretty decent and fast-growing dividend. The last one I got was $128. And the last thing I'll mention is that Starbucks does aggressive buybacks on top of paying a dividend. They halted their buybacks over the past couple of years, but they just approved another $20 billion towards dividends and buybacks. So that money being allocated to buying back their shares or paying dividends will push the price of the stock upwards. And I'm fully convinced that Starbucks will return back to $115 or $120 a share. In my opinion, it's only a matter of time. Now, the next one we can look at is Dominos. I currently don't own this company, but Bill Ackman really likes this company. He still holds it, and it's currently in a dip. Even though Domino's is just a pizza joint, it's easy to view this company as not being as valuable as different technology companies. But Domino's possesses a lot of the characteristics of a high-quality company. Because of the unit economics and cost structure, it has has a competitive advantage over other local pizza joints, meaning that they can offer about the same pizza, the same quality of pizza for a cheaper price than most local pizza joints. And that's the result of their scale. Domino's has a huge scale advantage, which leads to better cost structure. Domino's is also a company that's been growing revenue steadily. They've been harnessing technology, using that to grow their sales. They have massive growth in their EBITDA. This company churns out a ton of growing free cash flow. And of course, it's a highly profitable company, growing its net income at a very fast pace. Consider the fact that in 2017, Domino's had $60 million of net income in one quarter, and last quarter they printed $155 million of net income. They are multiplying their net income rapidly. And this, of course, is just a result of how fast this company is growing. Domino's is not only a dividend-paying company, it's not only a high-quality, wide-moat business, but it's a company that has fast growth. In their last quarterly earnings, Domino's grew their EPS by 10.4%, despite the fact that they were going up against very difficult comps. They were comparing against the pandemic lockdown quarters, and they still grew their EPS by 10%. That's difficult to do. Also, another thing that many people might find shocking with Domino's is just how fast this company's growing. In the fiscal 2021 year, the company had global net store growth of 1,204 stores. They grew 1,204 additional stores just in 2021. That means that every day, Domino's is opening 2 or more stores. Every single day, Monday through Sunday, they're opening up 2 stores a day. They currently have in total 18,380 stores. And in my opinion, I think they could double this amount over the next 10 years. They could have 30,000 plus stores. So Domino's is a dividend-paying company and a growth company, and I think it's situated well for the future. The reason that I actually prefer Starbucks over Domino's right now is because I think that Starbucks represents more of the opening of the economy than Domino's. I view Domino's as a company that you're more likely to use if you're staying home, you're ordering in, and it's more of a company that's suited towards a pandemic environment. And I view Starbucks as a company that will benefit more from people going back to work, working in offices that have Starbucks situated in them, working next to city centers, traveling, going to airports, and generally speaking, doing things outside of the house more. So when I'm picking through 2 high-quality companies, one that I think is more geared towards staying at home, and one that's more geared towards going outside, I pick Starbucks over Domino's. Now, I could be wrong, and maybe Domino's will outperform Starbucks over the next couple of years. That's just the bet that I'm making. I think either one of these are great companies, and they're currently both trading for almost the exact same PE ratio. Now, next up, we have Home Depot, which is also now in a dip. Now, Home Depot is a company that a lot of investors are confused about. It seemed like they're coming out with good news. Home Depot bumps up their dividend by 15%. The company is doing well. They beat their earnings report. Everything seems to be going well with the actual fundamentals of the company, but yet the stock price traded down 20% in just the past couple of months. It actually traded down more than the S&P 500. But when I think about it, I'm actually in agreement with the stock market here. First of all, Home Depot has been on an incredible run over the past 5 years, far outperforming the rest of the market. And even over the past year, it's been up way more than the S&P 500. And of course, this is a result of the fundamentals. The fundamentals of this company remain incredibly strong. In fact, if we look at Home Depot's earnings per share, we've seen explosive growth over just the past couple of years. They're now posting EPS in the $4 range every single quarter. This is astronomical earnings growth. And the company, of course, deserves to trade up in price when it posts these type of earnings. But looking at the company now, I think to myself, is Home Depot going to have the same type of earnings over the next couple of years that they had in the previous couple of years? In my opinion, it doesn't really seem like it. I remember back in 2020 and even 2021, people were lining up at the doors to go into Home Depot. Everyone was locked into their house. That was basically all you were doing was staying at home. So everybody naturally wanted to improve their homes. That's where you're spending all of your time. So that's where your thoughts went. And I think that as the economy opens up, as we move on from the pandemic, that Home Depot will have to fight harder to get more of your wallet share. And I would not be surprised to see a big deceleration with their revenue growth and with their earnings per share growth. I think the company will have a much more difficult time getting the share of people's wallets that they did previously. Now, I still own Home Depot, around $10,000 of it. I'm still bullish on the company. It still pays me dividends. It has a wide moat, and I don't think it's going anywhere. And I think the company will do just fine. But in terms of the next 2 years, I think there's probably better opportunities. Most of the enormous earnings per share growth for Home Depot are probably behind us. Now lastly, we have JP Morgan. This company just recently entered into a dip. For whatever reason, over the past couple of weeks, it just sold off. Here's what the 1-year chart looks like. Just over the past couple of weeks, it's down 17%. It now trades at a price of $138. Now, like all the companies we've talked about, I also consider JP Morgan Chase to be very high quality, diversified revenue source, and I think this company is going to be around for a very long time. I think it will outlive most of us. JP Morgan Chase is a company that a lot of investors naively compare to fintech companies. They say PayPal or Square or these other fintech companies are going to take over and outcompete JP Morgan Chase. But that's a misunderstanding of this bank. The consumer side is only one portion of this bank. You also have investment banking and commercial banking and their trading floors, of which they make enormous profits from. JP Morgan Chase manages over $3 trillion. That's very difficult to compete with. And PayPal and Square are not taking that away from them anytime soon. Now, I've repeatedly said that the reason I haven't purchased more of this company is because it's so expensive. It trades at a 1.9 price to book value. It just recently traded down to a 1.68. So I think the company's more fair valued right now. I don't think it's a screaming deal. I don't think it's super overvalued. I think it's somewhere in the range of fairly valued. Now, the way that I look at this is if I'm going to buy a bank, I want to get a lot of cash flow from that bank. That's one of the major benefits you get from going into financials. You get a high yield. And in my opinion, a 2.82% yield is just not high enough to buy a bank. I want to buy this company when it's yielding above 3.5%. So if JP Morgan Chase yields above 3.5%, I'll probably be adding to this position. But right now with it just yielding 2.82%, I'd rather look for a company that has higher amounts of growth with a little bit less yield. For example, right now I can buy Starbucks with a 2.1% forward yield. So Starbucks is yielding just underneath what JP Morgan Chase is yielding. When I look at the growth of the companies and probably their future dividend growth, I think Starbucks will grow theirs faster. So between the two companies, I'd rather buy Starbucks right now than JP Morgan Chase. Now, if this company does trade down to the point where the yield is 3.5% or above, and I don't find any better deals, I'll probably be buying more of this company. So there's 4 examples of companies that I've been looking at. I think they're all great companies. You could dollar cost average into any of them, and I think do fine in the future. But as of right now, I continue to hold $5,000 to $6,000 of cash, just waiting if any of these type of companies dips down a little bit into the territory where I think it's not only a good value, but screaming value, where it's a complete no-brainer. So even though I'm almost fully invested, I'll continue to hold a little bit of cash just in case that rare event happens where one of these companies moves into the extreme value territory. But that's my thoughts overall. I hope you enjoyed the video, and I'll see you in the next one.